Welcome back to the deep dive. Today, we're diving into something that, well, it can cause a fair bit of headache when you're putting together financial statements. What exactly do you do when a big chunk of the business, or maybe even just one significant asset, is clearly on its way out?
It really can seem straightforward on the surface, can it? Just sell it, book the profit or loss. But from a reporting standpoint, it gets complicated fast. If you just leave the results of that division you're about to sell all mixed in with the parts you plan to keep, well, you're basically distorting the picture for anyone reading the accounts.
Yeah, that makes sense.
And that's precisely why we have IFRS5, non-current assets held for sale and discontinued operations. It's designed specifically to sort of surgically separate out those
And
results.
surgical separation, I like that. And
Right.
that separation is absolutely vital, isn't it? Especially for you listening, our ACCA Financial Reporting students. Our mission today is really focused on the FR exam. We're going deep into IFRS 5, not just covering the what the rules, but the why behind them.
Exactly. And critically, how you actually perform the calculations and nail the presentation to, well, frankly, get those marks and steer clear of the common traps the examiners like to set.
Right, because there are traps.
Oh, definitely. And understanding the standard's objective helps avoid them. The whole point is to help users, investors, lenders, whoever's reading the statements, to better interpret the company's results and, crucially, make sensible projections about its future. They need clarity on the performance of the continuing operations.
Without the noise from the bits being sold off.
Precisely. You need to isolate the performance of the core business from the results of segments that are, well, about to disappear.
So it's like we're separating the asset's past life, its history of being used, from its new identity, which is basically just being an item up for sale. It's a fundamental shift.
That's a great way to put it. A change in identity, and the accounting absolutely has to reflect that immediate shift in management's intent and the asset's economic role. So let's start right at the beginning. What actually qualifies? What criteria does an asset, or maybe a group of assets, need to meet to be classified as held for sale?
Right. The classification hurdle. Let's get into it. Okay, so let's break down this core idea. We're talking about a non-current asset here. Could be property, plant, equipment, a big machine, maybe even a whole production facility. And the absolute fundamental test is about how its value, its carrying amount, is going to be recovered.
That's the essential starting point, yes. The carrying amount needs to be recovered principally through a sale transaction rather than through continuing use. It's a binary switch, really.
So as long as you're planning to keep using it, generating revenue from its operation, it stays under its normal standard, probably IAS 16, property, plant, and equipment, and you keep depreciating it.
Exactly. Business as usual. But the moment management makes that firm, committed decision to sell it, and the conditions are met, bang, IFRS 5 kicks in, and the accounting rules change completely.
And it's not always just a single asset, is it? Sometimes companies decide to sell off a whole package deal. The standard calls this a disposal group, right?
Yes, that's important. A disposal group isn't just the assets. It's defined as a collection of assets and any directly associated liabilities that the company plans to get rid of together in one single transaction.
Like selling off a whole business unit or a subsidiary.
Precisely. Think of it like that, a package deal. And if it is a group, the entire group, including those liabilities that are directly linked to it, has to meet the classification criteria we're about to discuss.
Okay, so if I'm selling a factory and it has, say, a specific loan tied to it or maybe some environmental cleanup obligations directly related to that site, those liabilities become part of the disposal group.
That's exactly right. They travel with the assets.
Yeah.
And that becomes really important for how it's all presented later on in the statement of financial position.
Yeah.
But before you even get to presentation, the asset or the entire group has to clear two essential classification criteria. These are absolute must-haves. Both need to be met.
Okay, criterion number one seems to be about readiness.
Number one, the asset must be available for immediate sale in its present condition. Now, notice the specific wording, immediate and present condition. It's quite strict.
Why so strict?
Well, it's designed to filter out situations where the sale is more hypothetical than actual. If the asset needs significant repairs, major upgrades, or perhaps there are regulatory hurdles that must be cleared before any buyer could realistically take over, then it fails this test. It's not ready now.
So let's say I have machinery, but it needs, I don't know, $50,000 of essential repairs just to make it functional for a potential buyer. Does that fail present condition?
Almost certainly yes.
Yeah.
If those repairs are necessary for the buyer to use it as intended, then it's not available in its present condition. The seller needs to be able to basically hand over the keys right now,
Right.
subject only to terms that are usual and customary for sales of such assets.
What about something like final environmental clearance for a factory site? Maybe it's expected, everyone thinks it'll come through, but the certificate isn't actually in hand yet.
That's a good edge case. It depends. If getting that clearance is just a standard procedural step that happens between signing the deal and the final closing, a typical closing condition, it might still pass. The key is whether the seller can actively market it and reasonably expect to complete the sale now without needing to undertake significant actions first.
Okay, that clarifies the readiness aspect. Now, the second criterion, which feels a bit more subjective perhaps, the sale must be highly probable.
Yes, and this is often where the real focus is, especially in exams, because highly probable isn't just management saying, oh yeah, we really want to sell this. IFRS 5 doesn't accept vague intentions. It lays out a pretty rigorous checklist, 5 specific conditions that collectively demonstrate a serious, actionable commitment to sell.
A checklist. Okay, examiners love checklists. Let's go through them. Condition 1 for highly probable.
Management must be committed to a plan to sell the asset. This needs to be more than just talk. Think formal evidence, maybe minutes from a board meeting, an official decision documented by senior management. If it's just an idea floating around, it doesn't meet this test.
Makes sense. Commitment needs to be official. Condition 2. Action speaks louder than words.
Pretty much. An active program to locate a buyer and actually complete the plan must have been initiated. You need to see concrete steps. Is the company talking to brokers? Have they started marketing? Are they preparing information for potential buyers? Just having a plan on paper isn't enough. They need to be actively working on it.
Okay, active program. Condition 3 sounds like it's about keeping it real, market-wise.
Absolutely. This one's designed to stop companies classifying something as held for sale when they're just testing the waters with an unrealistic price. The asset must be being actively marketed for sale at a price that is reasonable in relation to its current fair value.
So if an asset is realistically worth, say, $10 million, but the company lists it for $50 million, that's not a serious attempt to sell.
Exactly. That looks more like speculative fishing than a genuine commitment to sell now. IFRS 5 demands the asking price be in the right ballpark, suggesting a real intention to transact relatively quickly. An asking price slightly above fair value might be okay, but a wildly inflated price would likely cause it to fail this condition.
Right. The price has to be reasonable. Got it. Condition 4 brings in a deadline.
A very important one. The sale should be expected to complete within 12 months from the date of classification as held for sale.
12 months. That really emphasizes the imminent nature of this classification, doesn't it?
It absolutely does. IFRS 5 is focused on sales that are happening in the near term. If the disposal plan realistically stretches out to, say, 14 or 18 months, maybe because of complex regulatory approvals needed or significant market restructuring required before a sale is feasible, then it fails this test. It cannot be classified as held for sale yet.
And that's a common exam pitfall, isn't it? Assuming it qualifies just because they want to sell eventually.
A very common one. If that 12-month expectation isn't met at the classification date, the asset stays under its previous standard, like IAS 16. Depreciation continues. You only classify under IFRS 5 when the sale is expected within that year. And, importantly, if you classify it and then the sale doesn't happen within 12 months and there isn't a valid reason for the delay, you might have to declassify it.
Ooh, okay, declassification sounds messy. We might need to touch on that later. So 12-month expectation. What's the final condition, number 5?
Condition 5 is about the stability of the plan. It should be unlikely that significant changes will be made to the plan or that the plan will be withdrawn altogether.
So you need confidence that management is actually going to follow through.
Yes. If the whole sale hinges on, say, a very uncertain shareholder vote or maybe a regulatory change that might or might not happen, then the plan isn't stable enough and the classification wouldn't be appropriate. You need a high degree of certainty that the current plan will proceed.
Okay, let's quickly recap Section 1. To classify as held for sale, an asset must be ready for immediate sale in its current state, and the sale must be highly probable. Highly probable means management commitment, an active program, realistic marketing price, expected completion within 12 months, and the plan needs to be stable.
That's the gateway. Once an asset passes through that gate, its economic function has fundamentally shifted from use to sale.
And that triggers a whole new set of accounting rules, particularly around how it's measured on the balance sheet. Let's move into that. Right, so the asset is now officially classified as non-current asset held for sale, or NCA HFS. The valuation game changes completely. What's the core measurement rule under IFRS 5?
It's quite straightforward, actually, but has big implications. Once classified, the asset, or the entire disposal group, must be measured at the lower of its carrying value, CV, and fair value less costs to sell, FVLCTS.
Okay, lower of CV and FVLCTS. That sounds very much like the impairment principle we see in IS36, doesn't it? Recognize losses, but don't anticipate gains.
Precisely. It's a conservative approach baked into the standard. If the net amount you expect to get from selling it, FVLCTS, is less than what it's currently recorded at on your books, CV, you have to recognize that loss, that impairment, immediately through profit or loss.
But if the FVLCTS is higher than the CV,
Then you stick with the carrying value. You don't write the asset up just because its market value seems to have increased beyond its book value. Any gain is only recognized when the sale actually happens.
okay, clear. Let's quickly define FVLCTS more carefully. Fair value less costs to sell. What exactly counts as costs to sell for exam purposes?
Good point. Precision matters here. FVLCTS is the estimated selling price minus the incremental cost directly attributable to the disposal. The key word is incremental.
Meaning costs you wouldn't incur unless you were selling the asset?
Exactly. Think broker commissions, specific legal fees for drafting the sale contract, stamp duty or transfer taxes, maybe specific site cleanup costs required only to the sale. Those are generally included.
What about internal costs, like the time our own finance team spends working on the deal? Or general overhead allocation?
Generally, no. Those costs are typically excluded because they're not incremental. The company would likely incur those salaries or overheads anyway, whether the sale happened or not. So unless you hire, say, external consultants specifically for the disposal, those internal admin costs don't usually reduce the fair value to get to FVLCTS.
Okay, that distinction between incremental and non-incremental costs is crucial for getting the FVLCTS calculation right. Now, before we do the comparison lower of CV and FVLCTS, we need to be absolutely sure what the starting CV is on the date of classification. This means looking back at how the asset was accounted for before IFRS 5 took over.
Yes, this is a critical step in the sequence. You have to determine the correct carrying value immediately before applying the IFRS 5 measurement rule. And how you do that depends on the accounting model used previously under, say, IS16.
So if the asset was accounted for using the straightforward cost model,
Then it's simple. The carrying value just before classification is its original cost, less all the accumulated depreciation charged up to that date, and less any previous impairment losses recognized under IAS 36.
standard calculation. But what if the company uses the revaluation model for this class of assets? This seems like it could add a wrinkle.
It does, and it's a really important point for exam questions. If the revaluation model is used, there's an extra step before you even think about IFRS 5 measurement. The asset must be revalued to its fair value immediately before it's classified as held for sale.
Hang on, why revalue it under IS16 rules first? Why not just jump straight to the IFRS 5 comparison?
Because the logic is that under the revaluation model, the company's policy is already to carry the asset at fair value. So before switching its classification to held for sale, you perform one final update under IS16 to bring its carrying amount to the current fair value at that date,
And how is that revaluation recorded?
using the normal IAS 16 rules. If it's an upward revaluation, the gain typically goes to other comprehensive income, OCI, and into a revaluation surplus reserve in equity, unless it's reversing a previous loss that went to P&L.
Yeah.
If it's a downward revaluation, it usually hits profit or loss, unless it's reversing a previous surplus in OCI.
So you do the ISS 16 revaluation first, update the CV, and then you take that newly updated CV and compare it to the fair value less cost to sell under the IFRS 5 rule.
Exactly. Step 1. Apply IS16, depreciate to date, then revalue if applicable. Step 2. Apply IFRS 5 measurement. Compare the CV from Step 1 to FVLCTS and impair if necessary. Getting that sequence right shows a deep understanding.
Okay, that sequence is critical. Now, moving on from measurement. Probably the single biggest trap students fall into with IFRS 5 relates to what happens after classification regarding expenses.
Yes. Let's really hammer this home. Depreciation cessation.
Right. What's the absolute rule here?
Maximum emphasis needed. Once an asset is classified as NCA HFS, you stop depreciating it. Immediately. Full stop.
No more depreciation expense.
None. Zero. Nada. Depreciation reflects the consumption of economic benefits through use. Once it's held for sale, the logic changes. Its value is expected to be recovered through sale, not ongoing use. Therefore, the consumption concept underpinning depreciation no longer applies. depreciation must cease on the classification date.
This makes the classification date absolutely pivotal, doesn't it? Let's walk through that York example you mentioned to really cement the timing and the calculations, including how impairment fits in.
Perfect. So, York Ltd., they bought an asset, cost $120,000 on January 1st, 20X1, useful life, 10 years, straight line depreciation, 0 residual value. So annual depreciation is $12,000.
Okay, simple enough. The key date is
November 30th, 20X4. That's the day management properly classifies it as held for sale according to all the criteria we discussed. So first step, calculate the carrying value, CV, up to that exact date.
right. Depreciation needs to be calculated precisely.
Okay, so full years past are 20X1, 20X2, 20X3. That's 3 full years. Depreciation, $12,000 or equals $36,000. Full years past are 20X1, 20X2, 20X3. That's 3 full years. Depreciation. Then for 20X4, depreciation ran from Jan 1st to Nov 30th. That's 11 months out of 12. Full years past are 20X1, 20X2, 20X3. That's 3 full years. Depreciation. Monthly depreciation is $12,000. 12 was $1,000 per month. So for 11 months, $1,000 and $11,000.
Okay, so total accumulated depreciation just before classification is $36,000 plus $11,000.
Which gives us $47,000 in accumulated depreciation. The carrying value, CV, on November 30th, 20X4 is therefore $120,000, cost $47,000 accumulated depreciation. That's a starting CV for the IFRS5 test. Now, what's the other side of the comparison? What's the fair value less cost to sell? FELCTS on that same date, November 30th.
The example tells us the fair value is estimated at $70,000, and the incremental cost to sell, broker fees, etc., are $2,000. So FELCTS, $70,000, $2,000, $68,000.
Right. Now we apply the rule, measure at the lower of CV, $73,000,
Right.
and FELCTS, $68,000.
Oh.
The lower figure is clearly $68,000. Since our current CV, $73,000, is higher than the FELCTS, $68,000, we have an impairment loss.
How much is the impairment?
The difference, $73,000, $68,000 must be recognized immediately in profit or loss for the year 20X4.
And critically, what about depreciation for December 20X4? The company's year-end might be December 31st.
Doesn't matter. Depreciation stopped dead on November 30th. So for that last month, December 20X4, 0 depreciation is charged. The asset sits on the statement of financial position at December 31st, 20X4, valued at $68,000, classified under current assets as non-current asset held for sale.
Got it. So the P&L for 20X4 shows depreciation expense of $11,000 for JANF and an impairment loss of $5,000. That's crystal clear. What if the numbers were flipped? Say the FELCTS was $80,000 instead of $68,000.
Good scenario. If FELCTS was $80,000, we compare it to the CV of $73,000. We still apply the rule measure at the lower of the two.
So the lower is the CV of $73,000.
Correct. In this case, no impairment loss is recognized upon classification because the CV isn't higher than the FELCTS. And crucially, even though the FELCTS is $7,000 higher, you do not recognize that $7,000 potential gain. The asset is simply carried forward at $73,000 and still not depreciated.
Until it's actually sold. And the sale itself seems straightforward.
Relatively, yes. When the asset is eventually sold, you compare the actual net proceeds received with the final carrying amount, $68,000 or $73,000 in our examples. The difference is your profit or loss on disposal, which goes to P&L in the period of sale.
Okay, that wraps up the measurement and accounting for a single asset held for sale, but IFRS5 goes further, doesn't it? When the thing being sold is much bigger, like a whole division, we get into discontinued operations territory.
Exactly, and that has major presentation implications.
Right. Let's talk about discontinued operations, or DOs. This feels like a significant step up in terms of reporting impact. It's not just any old disposal, is it? There's a specific scope test.
Absolutely. Just because you sell something, even a large asset, doesn't automatically make it a discontinued operation. To qualify for that special presentation, which dramatically changes how your profit and loss statement looks, it has to meet 2 conditions. First, it must already meet the disposed of or held for sale classification criteria we just covered.
Okay, so it has to be on its way out based on the IFRS5 criteria. And the second condition?
It must also represent a significant strategic shift for the company. IFRS5 defines this as meeting one of 3 specific descriptions.
All right, description number 1 sounds like it's about size and structure.
Yes, it represents a separate major line of business or a geographical area of operations. The key word there is major. This requires judgment, of course, but we're talking about something substantial and operationally distinct.
So selling off, say, your entire European division would likely qualify. Or maybe exiting the automotive component sector if you also operate in aerospace.
Definitely sounds like it would meet the major test. But selling just one small retail store out of a chain of hundreds Probably not. Or maybe shutting down one product line that was always managed alongside several others within the same division, unlikely to be separate or major enough.
Okay, major line of business or geographical area. What's the second possible description?
This one's quite specific. It is a subsidiary acquired exclusively with a view to resale.
Ah, so if you buy a company purely intending to flip it quickly, maybe as part of an arbitrage strategy or something, it was never really part of your ongoing plans.
Exactly. It was never integrated or intended to be part of the continuing operations, so its results should be treated as discontinued right from the start.
Makes sense. And the third description allows for grouping.
Yes, it is part of a single coordinated plan to dispose of a separate major line of business or geographical area. This covers situations where a big disposal happens in stages, perhaps selling off different parts of a division over a few months. As long as it's all part of one documented, overarching plan to exit that major line or area, the results can be grouped together and presented as a single discontinued operation. So crucially, if the asset or group being sold doesn't meet one of these three descriptions, maybe it's just selling off the head office building or a fleet of surplus trucks, it's still treated as a regular disposal within continuing operations.
That's right. It would just be an NCA disposal. You'd calculate the gain or loss, probably show it as a separate line item within your continuing operations profit, but you wouldn't trigger the full discontinued operations presentation rules. The deal label is reserved for disposals that fundamentally change the scale or focus of the entity's future activities.
And getting that distinction right is key for deciding when this special presentation starts the timing of disclosure. Yes, the timing is critical. The separate deal presentation is required in the financial statements for the period in which the operation is either actually disposed of or the period it is first classified as held for sale, whichever happens earlier.
Whichever is earlier.
Okay.
And does this just affect the current year's P&L?
No, and this is really important for comparability. When you present comparative figures for the previous year alongside the current year, you must restate the prior year's figures as well. You have to split the prior year's results into continuing and discontinued components, just like you're doing for the current year.
Let's use that Angola example to make this concrete. They decided in 20X5 to close a car plant, but the actual closure didn't happen until March 20X6. What happened in the 20X5 accounts?
Okay, in 20X5, management had the intention to close, but let's assume the operation didn't yet meet the strict held-for-sale criteria. Maybe the plan wasn't finalized, or an active program hadn't started. So in the 20X5 financial statements, that car plant was still part of continuing operations. Its revenue, cost, profits, or losses were all mixed in. The only requirement then would likely be a note disclosure explaining management's future plans.
But then 20X6 rolls around and the plant is actually closed or meets the held-for-sale criteria early in the year. What happens in the 20X6 accounts?
Now it qualifies as a discontinued operation. So in the 20X6 P&L, Angola needs to show the results of that car plant up to the date of closure separately as discontinued. But crucially, when they present the comparative figures for 20X5 alongside 20X6, they must go back and restate the 20X5 P&L. They have to pull the car plant's 20X5 results out of continuing operations and show them on the discontinued line for 20X5 as well.
So the user can compare like with like. They see the 20X6 continuing results next to the 20X5 continuing results without the discontinued part clouding the picture in either year.
That's the entire objective: clean comparison, better forecasting.
Right. Let's get into the mechanics then. Presentation in the statement of profit or loss, PL. This is almost guaranteed exam territory, isn't it?
Absolutely. The core requirement is clear. The results of the discontinued operation must be presented separately from continuing operations. You structure the P&L so that you first calculate and show a clear subtotal: profit from continuing operations.
And that subtotal includes only the revenues, expenses, gains, losses, and tax related to the parts of the business the company is keeping.
Exactly. It's the performance of the core ongoing entity.
Then what comes immediately after that subtotal?
A single line item. It's typically titled something like profit loss for the period from discontinued operations. And very importantly, this single line must be presented net of tax.
One number? Net of tax. What does that single number actually represent? What's bundled into it?
It's a combination. It includes two main things. One, the operating profit or loss generated by the discontinued segment itself, from the start of the financial year up until the date it was disposed of or classified as held for sale. Two, any gain or loss recognized on the actual disposal of the assets, or the disposal group, associated with the discontinued operation, also calculated post-tax.
So it bundles the operational result and the disposal result together into one net figure. If it's just one line on the face of the P&L, where does an analyst find the breakdown? How do they see the revenue or expenses of the DO?
The standard requires that detail to be provided somewhere. You have two main options. Either show the breakdown, revenue, expenses, pre-tax profit loss, tax expense of the DO, directly on the face of the P&L, probably using columns, or disclose that detailed analysis in the notes to the financial statements.
The notes option seems more common in practice for complex companies.
Generally, yes. But for exam purposes, you often need to be able to calculate those components and show how they reconcile to the single line item.
Makes sense. What about the other primary statements? How does a DO affect the statement of financial position, SFP, and the statement of cash flows, SCF?
Okay, on the SFP, if the operation has been completely sold by the year end, obviously its assets and liabilities are gone. But if it's classified as held for sale but not yet sold, you have specific presentation.
Hmm.
All the assets within that disposal group are lumped together and presented as a single line item within current assets, typically labeled assets classified as held for sale.
So they lose their individual identity as PPE, inventory, receivables, etc.
Correct, they're aggregated. And similarly, any liabilities directly associated with that disposal group are also aggregated and shown as a single line under current liabilities, usually called liabilities associated with assets classified as held for sale. You don't offset the assets and liabilities, though. They're shown separately.
Why pull them out like that?
It prevents users from mixing up the assets and liabilities earmarked for disposal with the ongoing operational assets and working capital of the continuing business. Again, it's about clear separation for analysis.
And the statement of cash flows.
Similar principle. The net cash flows generated by the discontinued operation, covering its operating, investing, and financing activities, must be disclosed separately from the cash flows of the continuing operations. This separation can happen either on the face of the SCF or in the notes. It allows analysts to see the cash generation capability of the remaining core business.
This all points towards needing to be really careful with the numbers when separating things out. Let's use that Rudico example to walk through how you'd actually calculate the continuing operations figures for the P&L, especially if the original numbers were a bit messy.
Right. Rudico is a good case. They ceased a material business operation on March 30th, 2017. To prepare the P&L for that year correctly under IFRS5, we have to take the total reported figures and carefully strip out everything related to the discontinued part to arrive at the clean continuing figures.
For things like revenue and cost of sales, it's often just a subtraction exercise, right? Total reported minus the DO's contribution gives you the continuing figure.
Usually, yes. For those lines, it can be straightforward. But where it often gets tricky is with allocated expenses, like administrative expenses in the Rudico example. There was a hidden complication there.
What was the issue?
The information revealed that a $7,000 gain on the disposal of a non-current asset belonging to the discontinued operation had been netted off against the total administrative expenses in the initial draft P&L. That's not good practice, but it's something you might encounter.
So if the reported total admin expense was $70,000, and we know the DO had $10,000 of its own admin expenses, we can't just subtract $10,000 from $70,000 to get the continuing admin expense.
Exactly not, because that $70,000 figure is already artificially low due to the offset gain. We need to undo that offset first to find the true gross total admin expense before splitting it.
How do we do that?
The reported figure was $70,000 after deducting the $7,000 gain. So the gross admin expenses originally incurred must have been $70,000 plus $7,000 equals $77,000.
Okay, $77,000 is the true total. Now we can subtract the part belonging to the discontinued operation.
Precisely. The discontinued operation incurred $10,000 of admin expenses. So the admin expense attributable to the continuing operations is $77,000 gross total. $10,000 DO expense equals $67,000. That's the clean figure that should appear in the continuing operations section of the P&L.
And that $7,000 gain on disposal that we just added back and then effectively ignored for the continuing part, what happens to it?
It doesn't vanish. It belongs to the discontinued operation. It needs to be included when calculating that single net of tax line item for the DO. In Rudico's case, the DO had an operating loss of $3,000 before considering this gain. So the overall pre-tax result for the DO would be the $3,000 loss plus the $7,000 gain, giving a pre-tax profit of $4,000. That $4,000, after considering tax, feeds into the single line presented below profit from continuing operations.
Wow, okay. That meticulous adjustment and reorganization is really the heart of applying IFRS 5 correctly in presentation, isn't it? Making sure continuing operations are truly clean.
It is. It forces transparency about what's really driving the ongoing business versus the impact of disposals.
Okay, we've covered the core rules for classification, measurement, and presentation of both NCA HFS and discontinued operations. Let's touch on a couple of slightly more advanced points and then really focus on those common exam pitfalls.
Sounds good. One area that can come up is what happens after initial classification if the circumstances change, particularly regarding value.
Right. We established the initial measurement is lower of CV and FVLCTS, meaning you recognize an impairment if FVLCTS is lower. What if, say, 6 months after classification, the market picks up and the FVLCTS actually increases significantly? Can you write the asset's value back up?
Yes, you can, but there's a very important limitation. IFRS 5 allows for the reversal of a previously recognized impairment loss, but only up to a certain ceiling.
And what's that ceiling?
You can only reverse the impairment loss to the extent that it brings the carrying amount back up towards what the carrying amount would have been if the impairment loss under IFRS 5 had never been recognized. Crucially, though, the reversal is capped by the amount of impairment loss specifically recognized under IFRS 5 itself. You cannot reverse impairment losses that were recognized before the asset was classified as held for sale, say, previous losses under IFRS 36.
Let's try an example. Asset cost 100 TEO. Impaired under IAS 36 down to $80 a few years ago. Then last year classified under IFRS 5. At that point, its CV was 80K, but its FVLCTS was only 75K. So $5 impairment loss was recognized under IFRS 5, taking the CV down to 75K. Total impairment suffered is 25K. 20K under IAS 36, 5K under IFRS 5.
Okay, good setup.
Now this year, before sale, the FVLCTS jumps way up to 90K. How much of that potential $15K increase from 75K to 90K can we actually recognize as a gain?
The rule is you can only reverse the impairment recognized under IFRS 5. In your example, that was $5,000. So even though the FVLCTS is now 90K, you can only increase the carrying amount by $5,000.
Meaning the asset's new carrying value would be $75,000 plus $5,000, $80,000.
Exactly. You bring it back up to the level of that just before the IFRS 5 impairment hit. You cannot reverse the original $20,000 impairment loss that occurred under IAS 36 while it was still being used. That historical loss stays logged in under IFRS 5 rules. The extra potential gain from 80K up to 90K is ignored until the sale.
So IFRS 5 keeps that conservative approach even on the way back up. It only lets you undo the specific damage calculated by IFRS 5.
That's the principle. It prevents recognition of gains related to periods before the definitive decision to sell was made and the IFRS 5 rules kicked in.
Another quick point on timing and impairment, the interaction with IAS 36 before classification.
Yes, just to reiterate that sequence. Before you even apply the IFRS 5 lower of CV and FVLCTS rule, you must ensure the asset's carrying amount is appropriate under its previous standard. This usually means performing an impairment test under IAS 36 first, right up to the point of reclassification.
So, impair it, if necessary, under IAS 36 based on its value in use or fair value, less cost to sell at that point, then apply the IFRS 5 specific measurement test.
Correct. Get the IAS 36 value right, then see if IFRS 5 requires a further write-down based purely on the immediate net selling price.
Okay, crystal clear. Let's pivot now to the exam tactics. What are the absolute classic mistakes you see students making with IFRS 5 in the FR exam?
Number one, without a doubt, is the depreciation trap.
We flagged this earlier, but it's worth repeating. What does the mistake look like?
Students just keep depreciating the asset right up to the year end, often out of habit. They forget or don't apply precisely that depreciation stops on the exact date the asset meets the held for sale criteria. Calculating depreciation for even one extra month after classification is wrong.
And that incorrect depreciation throws off the starting CV for the impairment test, right?
Absolutely. It understates the CV, which might mean you incorrectly calculate the impairment loss or maybe misrecognizing one altogether. It also means the final carrying amount on the SFP will be wrong. Precision on that stop date is key.
Okay, depreciation trap number one. What's number two?
Timing misclassification. This is usually about classifying too early. Students might see management expressing an intention to sell or starting preliminary discussions and jump the gun, classifying it as held for sale before all 5 highly probable criteria are actually met.
So confusing intention with actual qualification.
Exactly. Remember, intent isn't enough. You need the active program, the reasonable price, the management commitment, the expectation of sale within 12 months. If any of those aren't locked in place, it's too early to classify under IFRS 5.
And what happens if they classify it, but then the sale doesn't happen within 12 months?
Well, unless there's a specific allowed reason for the delay, like unexpected regulatory holdups beyond the company's control, the standard generally requires you to stop classifying it as held for sale. It has to revert back to its original classification, say under ISS 16.
If it reverts back.
Then you have to reinstate depreciation. You'd calculate depreciation based on its revised remaining useful life and carrying amount, measured at the lower of its recoverable amount at that date, and its original carrying amount adjusted for depreciation that would have been charged if it had never been classified as HFS. Gets complicated, and that reversal scenario is definitely fair game for exams.
Okay, so timing is critical, both for starting and potentially stopping the classification. Pitfall number 3 relates to the big picture stuff.
Yes, DO scope errors. This is applying the full discontinued operations presentation, the separate P&L line, the SFP aggregation, to a disposal that simply isn't significant enough.
Like selling a single delivery van.
Or even a moderately sized office building, if it doesn't represent exiting a whole line of business or geographical area. Remember the definition. Major line of business, geographical area, or subsidiary bought for resale. If it doesn't meet that high bar, it's just a regular asset disposal within continuing operations. Don't use the DO presentation incorrectly.
Right, save the DO presentation for the genuinely major strategic shifts. And the final common pitfall.
Structural presentation errors on the face of the P&L. This covers a couple of things. Firstly, simply failing to clearly separate continuing operations profit from the single line for discontinued operations profit. That structure is mandatory.
And secondly,
failing to correctly calculate the continuing operations figures, especially for expenses where things might have been netted off incorrectly in the underlying data, like our Rudico example, forgetting to add back that disposal gain before subtracting the DO share of admin costs. That leads to the continuing profit figure being wrong. You have to ensure the continuing figures are truly clean.
okay, those are 4 big areas to watch out for. If you had one overarching tip for tackling IFRS 5 questions.
Focus relentlessly on the initial classification date. That date is the anchor point for everything.
Yeah.
When did depreciation stop? What was the CV at that moment? What was the FELCTS at that moment? When does the 12-month clock start ticking? If you nail down that date and apply the rules sequentially from there, you're much less likely to go wrong.
Understand the sequence, understand the logic, why the rules are what they are.
Exactly. It's not just about memorizing rules.
Yeah.
It's about understanding the shift from use to sale and why that changes the accounting story.
Fantastic. Well, that brings us towards the end of our deep dive into IFRS 5. We've worked through the strict criteria for classifying assets as held for sale, the crucial lower of CV and FBLCTS measurement rule, and that vital stop to depreciation, and the mandatory separate presentation for discontinued operations. It's all geared towards giving users of financial statements clearer, more predictive information, isn't it?
It really is. It's fundamentally about transparency. When a company decides to divest a significant part of its business, IFRS 5 forces them to show the underlying strength or weakness of the core business they're keeping, separate from the noise and potentially one-off effects of the part they're getting rid of.
Isolating continuing activities for better prediction, but as always in accounting, there's judgment involved, especially around classifications and allocations.
And where there's judgment, there's potential for, let's say, management of the numbers.
Which leads perfectly into our final provocative thought for you, our listeners, to mull over. Even when a struggling part of the business has been neatly carved out and presented as a discontinued operation according to the rules, how much bias might still creep into that remaining continuing operations section?
Yeah, think about shared costs. Corporate overheads, central IT functions, maybe R&D costs that previously supported both continuing and discontinued segments. Management has some discretion in how aggressively they allocate those costs to the discontinued part right up until it's gone.
So could they potentially make the continuing operations look a bit healthier by loading more shared costs onto the bit being sold off?
It's certainly something a shrewd analyst should watch out for. You'd want to look carefully at the allocation policies disclosed in the notes and perhaps scrutinize trends in margins or overhead ratios in the continuing operations section just before and after a major disposal. Are things looking perhaps a little too good afterwards? It's about looking beyond the face of the numbers.
A great point for critical analysis. Food for thought indeed. This has been The Deep Dive, taking a close look at IFRS 5, non-current assets held for sale and discontinued operations. And this is part of the ongoing SmartPass podcast series.
We certainly hope this has been helpful for your ACCA FR studies. We'll continue exploring key IFRS and financial reporting standards in future deep dives, always aiming to blend that conceptual understanding with practical, exam-focused application.
Absolutely. And don't forget, you can find links to other SmartPass study resources right there in the video description. They offer ongoing expert insights and structured support to help you ace your exams. We definitely invite you to subscribe to the SmartPass YouTube channel to catch all our future content.
Thanks for joining us. We'll catch you on the next deep dive.